Salam everyone. So we are starting off with a concept called bad debt. Bad debt is when a customer to whom we sold goods on credit basis, he has to return that amount to us in future. But if he is unable to return us that amount in future and it's confirmed that he won't be able to return us that amount, then we have to acknowledge him as a bad debt and we have to make certain entries. So this is the concept of bad debt. Now let's say we are given transaction, we sold goods on credit to Mr. A for $1,000. So how would we record this entry? We will debit Mr. A because Mr. A is our receivable and he's an asset, and if asset increases it gets debited. So Mr. A would get debited by $1,000 and sales gets credited by $1,000. So this is the journal entry for this transaction. If I talk about T account of Mr. A, so Mr. A is getting debited by $1,000, so I will debit him by $1,000, and we will write sales over here for cross reference because sales is getting credited because of it. Now let's say if Mr. A pays us this amount in future, then how would we make the entry in order to record the payment by Mr. A? We will receive this amount of $1,000. Let's say we receive this amount via check, so we will have to debit our bank account by $1,000, and our receivable would reduce when he pays us. Our receivable would decrease, so we will have to credit Mr. A by $1,000 because if asset reduces, we have to credit the asset. So Mr. A gets credited. So if I record this entry purely in just the account of Mr. A is getting credited by $1,000, and since Mr. A is getting credited, so because of it bank is getting debited, so we'll have to write bank over here. So if you look at the account of Mr. A, the account of Mr. A is settled in the books. He we sold him goods worth $1,000 on credit, and then later he came and paid us this $1,000, so his account is settled. But let's say if it's confirmed that Mr. A will not be able to return us this amount, let's say if it's confirmed that Mr. A will not be able to return us this amount, then we'll have to, because of reasons like Mr. A got declared bankrupt, so he has run out of the business, and it's confirmed that he would not be able to return us this amount, then we will have to remove this $1,000 from the account of Mr. A, because if we leave the account of Mr. A like this, it would look like we have to receive $1,000 from Mr. A. So in any way, in order to remove this account from our book, we'll have to credit Mr. A by $1,000. But what will we write here? What will we debit if we credit Mr. A? The account that we'll have to debit because we are crediting Mr. A is bad debt. So our entry would look like this. Bad debt gets credited by $1,000 and Mr. A gets credited by $1,000. So this is the entry in order to record bad debt. Bad debt being an expense gets debited because any expense that increases gets debited, and Mr. A, because our receivable would reduce when we acknowledge him as our irrecoverable debt, so we'll have to credit Mr. A because if asset reduces, it gets credited. Now the second entry that we need to know is, after we have recorded the bad debt, we also have to know, like at the year end, we have to transfer this bad debt amount into income statement. Before jumping onto that transaction, you should know income statement is also a technically T account. Although we follow a certain format in order to make an income statement and we do not make as a T account, but you should realize income statement is also a T account. Technically income statement is also a T account, and all expenses gets debited in income statement. All expenses comes on debit side of income statement. This is income statement's T account. All expenses would come on debit side. All incomes would come on credit side. And if I talk about any expense account would have to get credited if income statement is getting debited. Though this is what the entry would look like. Expense gets credited, but income statement gets debited. Income statement gets debited and expense gets credited. This is what is the entry in order to transfer any expense into bad debt, and any expense into income statement. So we can replace expense by bad debt. So if you look at bad debt account is getting credited and income statement is getting debited. So what would our transfer entry look like? Transferring entry would look like this. Income statement is getting debited by $1,000, but bad debt is getting credited by $1,000. So second entry that we made is in order to transfer bad debt into income statement. I hope that makes sense. Now if I just summarize by removing the expense account. So if I just summarize, we need to know two things in order to record the entries for bad debt. Number one, bad debt debit, and Mr. A, whoever is our individual receivable who's getting declared irrecoverable, should be credited. So Mr. A gets credited. So this entry is done in order to record bad debt. Second entry, if the examiner asks us to transfer this bad debt amount into income statement, so we'll have to transfer this by debiting the income statement and by crediting the bad debt account by $1,000. So this is our transferring entry, transferring to income statement. I hope this makes sense. We'll cover questions in the next video, and also in the next video we'll also cover the concept of provision for doubtful debt.